Hopefully now you can hear me online there. Great. Okay, so thank you for coming. What we've had over the last 12 months has been an incredibly volatile market. I ran a few presentations in sort of Feb and March when we were down below 5,000, and all of a sudden now, a few months later, we're 17% higher and at 5,600, which is the top end of our current sort of valuation range. So I spent a lot of time around there talking about what were the short-term drivers, what the market was pricing in, and we had a sharp sell-off in commodity prices. We had some sort of poor or sloppy policy out of China, who were devaluing the renminbi, and also put some circuit breakers in their market. And we also had some weak data over the December sort of January period. So really there the market was sort of pricing in a recession that we didn't see happening. Consequently, we sort of leveraged portfolios and really ratcheted our equity exposure up to the maximum end of the range. And over the last week, we've done the exact opposite. So we've been fairly active in the last week. And look, I think we'll see continued volatility, and I think that requires continued active management of accounts. So just to backtrack, our market hit sort of 6,000 in February, March last year. That was the first time since the GFC that we said, hey, the market's a bit expensive, and we went to nearly 30% cash in the core share portfolio. When the market sort of hit 5,500, we got fully invested. It had come off 10% and was closer to our sort of fair value range. We certainly didn't expect it to fall 20, but as it got more and more undervalued, we progressively ratcheted up our equity exposure, which is difficult to do when there's sort of screaming red headlines and the market's come off 20-25%. But we really do take a genuinely contrarian approach here. Over the last few months, the market's shot up sort of 17% off those fair blows, and now it's again pushing that upper end of our fair value range. If we look at that volatility in context though, so if we go back over 10 years, you can see the 20% swings that we've had over the last 12 months in context of the GFC, and also in 2012, that was the last time that we had a 20% correction, and that was around the time that people were concerned about the sovereign debt issues in Europe and Greece defaulting and being kicked out of the euro, and a real concern that there was going to be another financial credit event. Again, it was our view there that that wasn't the base case, and that was the last time that we put a bit of leverage in portfolios. We had a couple of great years, and then a 20-25% correction last financial year that we're now coming out of. Okay, if we look at the 10-year graph of the ASX 200 accumulation index, so that includes dividends reinvested over the period, you can see that the market's actually, in fact, well above the pre-GFC highs, and again at this level today, it's knocking on the door of the previous high that we hit in Feb last year, which warrants a little bit of caution for our mind. Just to put that volatility in context though, I think this is a good chart that we run through briefly from time to time. And what it shows is that almost every year you will get a share market correction of sort of 10% or more. That's actually fairly ordinary. There's usually an issue that pops up at some point over the course of the year that concerns markets and causes a sell-off. What we spend a lot of time focusing on is what's the underlying economic environment like, and is that sell-off a buying opportunity, or is this something or something more sinister where we really need to build up some cash? So the 10-15% corrections are quite normal. What we want to try to avoid is when you get a deep recession and then you get the GFC type or the much larger sell-offs and corrections. G'day, how you doing? We've only a couple of minutes in, so no worries at all. So if you go back to the sort of early 70s recession and there was a big oil price shock, that's where you got some really big market drawdowns. late 80s, early 90s recession, and then early noughties recession. That was the sort of tech wreck and recession. Now, Australia avoided that one fairly well. And then the GFC. So if there is a genuine economic downturn around the corner, then even if the market's fallen 10 or 15%, you want to increase your cash weighting. If there's not, then all of these other drawdowns are a buying opportunity. So what that shows is that the average market sell-off during any given year is around 12%, but the annual rise of the share market over a long period of time is around 12% as well. So I suppose the key message there is that you need to be able to put up with that short-term volatility to get that longer-term return. But what we spend a lot of time focusing on is whether it's one of these events and whether it's not a buying opportunity, it's something a bit more sinister. Okay, so what has happened since February? So since February, when our market was 47.50, we've seen a stabilisation in commodity prices. So late Feb clearly marked the bottom of the commodity price cycle. We saw the oil price that was up above $100 a barrel for a few years there, drop below $30 a barrel. Since then, it's pushed up over 50 and now back to 40. We've seen the same thing right across the commodity complex, the same thing with iron ore prices and most of the base metal prices that have had a decent run over the last little while. So that was one of the key negative drivers or drags on our market. We've also seen a real stabilisation in some of the Chinese economic data and also the currency. Now, I've got quite a few charts on Chinese currency and the Chinese economy and market if people are interested, but I sort of put those right to the back of the presentation. They were very topical in January and February when markets were skittish, but things have sort of calmed down now, but I can circle back to those if people are interested. And the main recent driver that I'll talk about a lot today is the expectation for quantitative tightening or for interest rates going up and central banks to stop printing as much money. That expectation of tighter financial conditions has really been pushed out since the Brexit vote. Now, I think that that's a little bit premature, and I think we'll see that unwind over the next sort of 3 to 6 months, and that creates a little bit of a financial risk. And I'll just have a look at some of the valuations and some of the sectors that I think are being, or that we think are being artificially stimulated by that expectation. So that, to our mind, is the main driver of financial markets at the moment. We have, however, seen some better economic data come out of the US and Europe over the Christmas period, sort of the December quarter and the first quarter. That's where most of the US is sort of under snow. It tends to be a bit seasonally weak, and we saw a drop off in a fair bit of the data, and that was coinciding with plummeting commodity prices and some big moves in currency markets that really got the world concerned that we're on the brink of a major economic downturn. Obviously, that didn't eventuate. And over the last 3-4 months, we've seen some better economic data that's more reflective of what we think the current environment represents. So since Feb, we saw our market up 6% in July, and it's about 17% off the Feb low. So what have we done? And I'll run through the portfolios, but we just in the last week have significantly reduced our equities exposure. In our large cap Australian share portfolio, we now have 20% cash. In our mid cap portfolio, we're at about 18% cash. In one of our international ETF portfolios, we've put a little bit of a short position in there. So effectively, it means that we've got 50% share exposure and 50% cash. Now, the net result of all of that, now again, this depends a lot on client to client or the planning groups that we deal with where we build and manage model portfolios for them. But the net result for a typical sort of balanced fund is that we've reduced the equity exposure from about 75% earlier this year, where we clearly thought that markets were 15 to 20% undervalued, to around about 58% now. So where we've built up some cash, I suppose that just puts it into perspective in that we're not really negative on the outlook, but we're just saying markets are no longer 15 to 20% undervalued, so we don't want it to have the equity exposure right at the top of that range. We've brought brought things back to more of a half-half sort of position, with a bit of cash, particularly given some of the risks and some of the events coming up. From an Australian share market perspective, and I'll touch on this in a bit more detail, we're just about to get into the full year reporting period in August. So all of the companies, or most companies, report their full year results for the year to 30 June, which, given the level of the market at the moment, the underlying economic growth rate, which is okay, but it's not fantastic, we'd expect a few opportunities to be thrown up over the next few weeks. So overall, what I find quite interesting is that our overall economic view from February to today is largely unchanged, but market valuations are almost 20% different. And I think that is predominantly the result of this interest rate or quantitative tightening expectation being pushed out. Not a lot other than that has changed. Okay. So the key questions, in February we were sitting there and the key question was, okay, are things really this bad? With markets falling 25%, are things really this bad? The market was pricing in a recession. Our view at that point in time, and I won't go through so many of the slides from Feb and March, but I can pull them up if anyone's interested. Our view then was that we were in an environment of okay, but slightly below trend economic growth. We're in an environment where interest rates were low and would continue to be low for a prolonged period of time, which should help asset price valuations and equity markets. And we also spent a fair bit of time looking at why commodity prices had fallen so sharply and determining whether it was a leading indicator of economic activity or it was more a supply response. And that was certainly the camp that we were in. So if you look at commodity prices like oil and iron ore and copper and those sorts of things, historically, if you go back through previous decades, if you get a decline in those commodity prices, it usually reflects a slowdown in economic activity, and it can be a lead indicator of a slowing growth environment or a downturn. The environment over the last 12 or 18 months was very different because we had 2 or 3 years of extremely elevated commodity prices with oil over $100 a barrel and iron ore got to $200 a tonne. So you had a prolonged period of extremely elevated prices, which generated a huge supply response. So you saw the BHPs and the Rios Navales and all of the oil and gas stocks spend an absolute fortune ramping up production over the last decade, really from 2001 when China entered the World Trade Organization and started to open up its markets. So you saw all of this capital investment come into the market, and so you saw a huge supply response. You saw the supply of oil and iron ore and most of these base metals coming onto the market shoot up 20, 30, 40%. At the same time that China's growth was tapering off. So the demand for iron ore and the demand for oil didn't fall. It was just we had so much supply coming on at the same time that created that downturn. So now we're sitting here 4 months later and the market's 17, 18% higher. So the question now is, are asset prices really reflecting the underlying economic reality, or are they being driven artificially by central bank activity? And that's what concerns us at the moment, and I'll run through that in a bit more detail. Okay, so what we've seen over the last decade plus, but since the GFC, is that when there's a severe economic downturn, the first thing central banks do is cut rates down, cut rates in the US to 0, and then they start unconventional monetary policy or quantitative easing, which is physically printing cash to buy financial assets and drive long-term interest rates down. To buy financial assets off, it started purely off the major banks to make sure they were well capitalised, but it spread to corporate debt. In Japan, they're buying the equity market. So the Japanese central bank, or the Bank of Japan, now is a top 10 shareholder in a lot of listed Japanese companies. So they're not just buying Japanese government debt to get interest rates even lower or to help fund a budget deficit. but they're buying corporate bonds and they're actually buying equities as well at the moment. So what you've seen is, and it's quite amazing, and we scratch our head a little bit at the moment, but effectively the interest rate on 40% of the G7 economies' government debt, so the sovereign debt, now has negative yields or negative interest rates, which is amazing. We've seen Europe and Japan cut interest rates to below zero. There are 6 central banks around the world now that have interest rates below zero. And we saw last month Germany sold 3.2 billion euros of 3-year debt at a yield of negative 4.8%. So if you buy that and hold that to maturity, you're losing 0.5% per annum for 3 years. It's quite mind-boggling. Now, speaking to bond fund managers, you know, they sort of scratch their heads a little bit as well, but if you ask them if they've bought any of this debt, most of them will say, yeah, we have. And the expectation there is that, well, just because you're going to lose money between now and maturity doesn't mean you can't make money out of it. Now, to make money out of it means that your expectation is that interest rates are going to go further into negative territory. But to me, it's starting to feel a little bit like a game of musical chairs. That eventually people are going to be trying to get out of these positions and it'll become a very crowded trade and it'll unwind fairly quickly. So if we have a look at government bond yields globally, and this is just a basket of developed economy bond yields from, you know, the late 90s when we had the last sort of economic down, well, sorry, 2 downturns ago, showing my age now. You had, you know, government interest rates at sort of 8-9%. In the GFC, we saw them cut right down to zero, and over the last couple of years, they've moved down to, you know, sort of 0.5%, with some debt in negative territory. So the key question then is what are market expectations for interest rates going forward, and then what impact is that having on the valuation of assets, of investment assets? And then the more interesting question, I think, and the one that we think about a lot, is what if the market's wrong, and what if interest rate expectations change? Then what impact will that have on financial markets, and how do we position for that? So if we go back 6 to 12 months ago, or 6 months ago, the US Federal Reserve, we go back a few years ago, and they've done this well in that they cut rates to zero very quickly. They realised the extent of the issues in the financial sector, so they started quantitative easing. They pumped a heap of money into the economy, and the US economy recovered quickly, or relatively quickly, and it's been growing at a reasonable rate for the last 3 years. And economic growth in the US is actually pretty solid at the moment and better than most other regions of the world. Europe took 3 years too long to act, trying to get, you know, 7 or 19 EU members to agree on a policy action is near impossible. And it wasn't until the crisis in 2012 that they really acted. The issue then, though, was because they took so long to act, they've had to engage in more and more and more unusual economic activity to try and get inflation and growth out of Europe. Now, just back on the US, if we go back 6 months ago, so they've had effectively a flat Federal Reserve cash rate of 0.25% right back since the GFC. They put rates up for the first time at the end of 2015, or start of 2016 anyway, about 6 months ago, to 0.5%. Now at that point in time, they came out and said, we expect to put interest rates up 4 times at 0.25% each over the course of this year. So get that cash rate from 0.5% to 1.5% over the course of the year. We were expecting US government bond yields or sort of interest rates to push up and start to normalise. However, we then had the commodity price sell-off and the financial markets volatility in Jan and Feb, which pushed things out a bit further. And then we had the really unexpected Brexit vote, which has created more issues in Europe, and I can touch on those in a bit more detail later. But the market then very quickly went from pricing in an orderly, measured rate tightening cycle in the US to rates not going up at all over the next 12 to 18 months. Futures markets at the moment are now pricing in a 60% chance of a rate hike in the US in July next year. So they're effectively saying no rates for the next 12 months. But if you go out further and you go out to 2026, they've got the 10-year government bond yield at 2.4%. So they're effectively saying that rates are not going to go up much. So the US 10-year bond yield now is sort of 1.5, 1.6. So they're saying it's going to go from 1.6 to 2.4 over the next decade. So you have lots of financial assets at the moment that are being priced off extremely low interest rates and an expectation that interest rates are going to stay low in perpetuity, which we think presents a little bit of a risk. So if we look at this graph here without going through the detail too much, the Taylor rule here is an old rule that's been around for a long time, but it basically says what interest rates should be given underlying economic growth and inflation, which are really the two things that you should use to make your rate decisions. So it's saying that in the US, rates should be 2.5% by now. So they're coming out of the GFC, yep, it was right to keep rates at zero, but they've been very, very slow in pushing them back up, which means that there is a risk that at some point they're going to move up sharper than the market's pricing in at the moment. Okay, now I'll sort of circle back to that and talk about it a little bit more in detail, but I think it's really, really important at the moment for almost all financial markets, and it will be the key, as it has been the key driver over the last 12 or 18 months of markets. It will continue to be over the next little while, but it's starting to present more of a risk than a potential benefit. You know, over the last few years, whenever you saw huge central bank activity to push rates down and to pump money into the economy, it was really bullish for markets. We think we're at the point now where it's starting to become a little bit of a risk. Okay. So let's just have a look at the global environment. And as I mentioned, our view of the world really hasn't changed much in the last 6 months. We're in an environment where global growth is okay. It's not fantastic. It's not above trend. So we're not in an environment where the global economy is booming, which is going to deliver strong earnings growth and potentially rates pushing up, but an environment that's really bullish for earnings. But nor are we anywhere near a global recession, which is what markets were pricing in earlier this year. So you've got global growth running at about sort of 2.5% for the next few years, and that's almost exactly what it's run at for the last 2 years. So despite all of the market volatility and all of the action by central banks, global growth over the last 3 years hasn't really changed much. And the outlook is that it's probably not going to change much over the next couple of years. There is pretty big divergence, though, between some of the developed economies, Japan, the Eurozone, and emerging markets. And there is quite a bit of divergence within Europe and within emerging markets as well. But as I mentioned, the US is growing reasonably strongly. That figure there, I think, is probably a little bit light, and that figure can probably come up a little bit, and I'll touch that. But we've had US growth at sort of 2.5% for the last few years. We think it'll be around about 2.5% for the next few years as well. Japan's economic growth rate is flat, and that's why we've got such interesting policy coming out of Japan. But the Eurozone is actually doing okay as well. So the Eurozone, represents about a third of economic growth at the moment. So that's a big turnaround. If you look at where they were in 2012 when Greece was imploding and they'd fallen back into recession, the European economy is growing at sort of 1.5% at the moment. And we think that's fairly sustainable, and sustainable particularly given how much support they're getting from central banks. And Asia and developed markets and emerging markets are growing at 5 or 6%. Australia's chugging along at somewhere between sort of 2.5% and 3%. So again, okay, not great, but far from recessionary. So we've got an environment where growth is okay, but interest rates are super low. So in Australia, and we've got the rate decision at 2:30 this afternoon, which would be a really interesting one, and I'll talk to you about my thoughts there. But in Australia, we've had a period of relatively low rates, high by global standards, but record low by our standards. And that's starting to work, and the transition of our economy from the mining, capital expenditure and services to the traditional East Coast parts of the economy, things that are interest rate sensitive and really sensitive to the currency, like financial services, construction, housing construction, property, tourism, education, all those traditional sectors have been benefiting from the lower currency and from the low interest rate environment. So we're actually seeing the economy sort of pick up a little bit over the last 12 or 18 months, and it's really been driven by the non-mining part of the economy. And that's exactly what the Reserve Bank wants with the interest rate setting that they've got. It's a slow transition and it'll roll out over a number of years, but it is actually happening. Okay, so the RBA this afternoon will be really interesting. If you sat there and said, okay, well, if growth in Australia is running at 2.5% to 3%, why do we have rates at 1.75%, and why are some participants in the market calling rates to go all the way down to 1%? Well, the issue is that transition that we spoke about. We've had a big driver of the Australian economy being the resources boom, with all of this capital investment that is now almost completed and rolling off, and in the environment where the east coast of Australia has effectively been in recession for much of the 2008 to 2011 period. So they were in a difficult environment there where the West and anything related to mining was absolutely booming, but if you weren't leveraged to that mining sector, you were doing it pretty tough. As the mining sector has rolled off, those other sectors are starting to pick up. And that's by design, and it's a reflection of the fact that the low interest rate environment is starting to work. So this chart here just shows the RBA cash rate. So you can see that they cut rates from sort of 6.5%, excuse me, all the way down to 3% during the GFC. As markets and the economy recovered, they started putting rates up again, but then we had the ructions in Europe, and we had all of this easing out of Japan and Europe and the US, and at the end of the mining boom. So rates have been cut now all the way down to 1.75%. Now historically, the blue line here is the inflation figure. And again, sorry, this economic stuff tends to get a little bit boring. I'll move on to the portfolio soon, but it's important when thinking about where interest rates are going. The Reserve Bank has always said that they have an inflation target of 2 to 3%. If inflation is significantly below the target band, then they'll cut rates. If inflation is above the target band, then they'll put rates up. And you can see that they've done that most of the time. Right now, inflation is running below the target band. So there's an expectation that rates will be cut, and there are some in the market saying that we could get another further 2 or 3 rate cuts to get it all the way down to 1%. My view, though, is a little bit different in that I don't think they should just yet, for a couple of reasons. One, the overall economic growth rate actually isn't too bad. But the second reason there is that we're in an environment now globally where inflation is very low, and we're also in an environment where interest rates are extremely low, and there's a lot of argument out there as to whether even lower interest rates will have any impact on inflation at all. And we're starting to see in Europe and Japan, they've gone into deep negative interest rates, and it's not really having a big impact on inflation yet. Now, it will at some point in time, but if we go from 1.75 to 1.5, I really don't think that's going to have a big impact on economic activity or bank lending. And as you move into negative rates like we've seen in Japan and Europe, I think it's actually having a negative impact. It's penalising savers, it's creating more uncertainty, and it's actually slowing down consumption. So I think it's starting to have the opposite effect of what they want. So it'd be very interesting to see what they do. And when they set this target band, it was really on the back of the late 80s and the early 90s, where you had booming inflation that was creating big financial risks. So it was a target band to try to keep inflation under control. It wasn't designed to try to stimulate inflation at the other end. So if we're in a world of low inflation, is cutting rates further here going to have any impact? The other issue, and actually I'll just flick over to here, the key thing to watch though, we think, will be the currency. So if we look at the Aussie dollar versus the US dollar, it's pushed right up over the last little while to sort of 75 cents. Now, if we go back a couple of years ago, we're at parity with the US. Commodity prices rolled off, and they acted and cut rates to get the currency down. So that's the one variable we think. If the currency continues to push up to 78 cents, then it'll force the RBA to cut, because they need the currency low to continue to stimulate that East Coast interest rate sensitive and currency sensitive part of the market. However, if we're in an environment where the US is putting rates up, why would they cut now when the US is likely to put rates up over the next few months, which would see our currency come down? So if they cut here and the US puts rates up, our currency will likely overshoot, we think. But that's the one to watch. Okay, so cash rate expectations. There are a lot of participants in the market that have the cash rate going all the way down to 1%. Now that is driving some of the valuations that we're seeing in markets. And we actually think there's a bit of risk there, because we think there's a fairly high probability that rates won't go that far and that we're pretty close to the bottom of the tightening cycle. And I'll give you some examples of that now. So if we look at the Aussie share market, this is just the 1 year forward PE of the Australian share market of the ASX 200. So for those of you who haven't listened to any of these before, so the price earnings ratio, or the PE, is just a simple valuation metric where you take the price of a market or a stock and you divide it by the earnings that you're expecting to deliver from that market or from that share. So to give you a simple example, if you've got a company trading at $10 per share and it's forecast to deliver $1 of profit per share, then it's trading at 10 profit. If that share price goes to 20, but its earnings are still $1, then the PE ratio or multiple's gone from 10 to 20 times, so it's twice as expensive. So the higher this is, the more expensive the market is as a function of earnings. Now, if we go back to February, the PE got down to sort of 14 times, which was in line with the longer run average. If we go back to 2012 or the GFC, it got to levels that we'd almost not seen before, not since the major market meltdown in the late 80s. If we look at the market now, it's right at the top end of the band. So the long run average is around 14 times earnings. Now, there's a real argument out there in the market that the lower interest rates are, the higher the multiple you can pay for investment assets such as shares. So the low interest rate environment is pushing this band up a little bit, but that's where we say there's a real concern that if rates don't stay low and they start to push up, you can get a pretty violent share market reaction. So at the moment, as we said, in Feb this year, when the market was 17% lower, we saw the market as being fundamentally cheap based on where it should trade in the current interest rate environment and with an economy that's chugging along doing okay. 17% higher now, it's trading at the top end of the valuation range, and interest rates we think are right at the bottom of the range with potential to move up. So we're not saying that the market's in bubble territory and really expensive like back in 2000, we're just saying it warrants a little bit of caution. Okay, so what are valuations pricing in? So if we were at the top end of that PE range or that multiple range, what we would ordinarily expect is some pretty strong earnings growth. So if a market or an investment's trading at a high multiple, but it delivers 10 or 15 or 20% earnings growth, then this time next year it's cheaper, and if it does that again, 12 months later it's. So if you're at the top end of the multiple range, you want a strong economy and you want strong earnings growth coming through, because 12 months from now, that stock or that market or investment won't be cheap anymore. Or it won't be expensive anymore. It'll be cheap. Well, we're not in that environment. We're in an environment where economic growth is okay, but it's certainly not booming, and it's certainly not strong enough to deliver really strong underlying earnings growth. What is the environment? We're in a low growth, low inflation, and very low interest rate environment. And it's that interest rate, that low interest rate environment that is driving valuations. So if we have a look at the Aussie market and what we've seen over the last couple of years and what we expect going forward, over the last 2 years, we've seen the earnings of the Australian share market decline last year and this year. However, if we break the market down by sector, that was predominantly driven by the resource companies. And that's no surprise to anyone. If the oil price has gone from 100 to 28 and back to 40, it's still less than half what it was 18 months ago. So resource earnings have been absolutely belted. The market ex resources is delivering some growth, but not double-digit earnings growth that would warrant a high double-digit multiple. It's delivering earnings growth of 2, 3, which is in line with what you'd expect from an economy growing at 2 or 2.5%. Now, we spend a lot of time looking at these drivers and thinking about the sectors that are likely to deliver better earnings growth than the rest of the market, and then try to position portfolios accordingly. So we've had 2 years of big or of huge declines in underlying resource earnings. We're expecting financial year 17 earnings to actually pick up again because we're through the bottom in that commodity price cycle. If we look at banks, we've had really flat but positive earnings growth from the banks over the last couple of years and really over the last 4 years. And then if we break down the industrial sectors, again, there's very, very divergent performance. Okay. On the back of that, you'd expect really divergent share price performance as well from those different sectors. And I'll quickly run through this, but if we have a look at, this is to the end of July, so the ASX 200 was actually down slightly for the 12 months to the end of July. If we add back dividends, then you've got a positive sort of 2.5–3% return. Within the sectors though, we've seen again some really big divergence, which you'd expect given the divergent underlying earnings growth. So financials were one of the worst performing sectors at -8%. We had resources at -8.5%, but what's really interesting is the resource market has put on 35% in the last 6 months. So in the period before that, it had dropped 40 or 50. So we've seen a really big turnaround in the resource and the energy stocks. So from, you know, up 10% over the last 6 months, but still down 25% over the last 12 months. And the sector that we scratch our head a bit with is the utilities and the real estate investment trusts. So property, infrastructure and utilities, these are the sectors that are most impacted by that really low interest rate environment. And I'll run through those sectors now. So looking at valuations, as I mentioned, going forward, if we look at the current year, so the year to 30 June that's just finished, our market's now trading on about 18 times. So that's 18 times historic earnings, which is right up the top end of the valuation range. Now, the market's expecting sort of 6–7% earnings growth. So the 1 year forward PE multiple is 16.5. So again, towards the top end of the valuation range, which makes us a little cautious. The banks, however, are still reasonable value at 12.5 times. The property trusts, though, are more expensive than we've ever seen them. And we're talking, you know, almost 30 or 40% above the net assets of the trust. And I'll talk about that in a little bit more detail. And that's because of the environment that we're in, where the market is effectively discounting zero interest rates forever. So I'll just touch on that with in a little bit more detail now. So real estate investment trusts or property trusts effectively are vehicles that will own commercial buildings like this, shopping centres, all those sorts of things. Collect the rents, pay the bills, and then distribute that rental income to investors. So it should provide a steady income stream that should grow a little bit over time as you get rent increases. Now, they're historically priced off the cash rate or the risk-free interest rate. So if, for example, you're in an environment where the cash rate is 4%, then you holding property trusts, taking that additional risk or additional financial risk of holding property, you'd probably want, you know, a 6, 7 or 8% interest rate, 6 or 7 or 8% distribution rate. Now, as interest rates have been cut to almost zero globally, you've seen the prices of these assets continue to push up and up and up and up, and the distribution yield continue to decline. So the distribution yield on the sector now is around about 3.2%. You know, back before the GFC, you'd want 7s and 8s from this sector. So that, to us, is, you know, almost getting to sort of bubble territory. And the reason these assets are being driven the way that they are is because in a low rate environment, the whole world is trying to chase yield. It's trying to chase income wherever it can get it. So if you can't get income from cash accounts, if you can't get it from debt or from government bonds, then where can you get it? Property trusts, equity markets, utilities, these sorts of things. So the prices have been bid up to the point that they're now really expensive. So relatively, if you're sitting in an environment with zero interest rates, the share market still looks pretty good value. So what this chart here shows is the dividend yield of markets around the world versus their government interest rates or official interest rates. So in Australia, this has dropped now down to about 1.7 or 1.8, but you're still getting a 4.5 or 5% dividend yield from the Aussie share market. In the UK, it's very similar. In Europe, where you've got zero or almost negative yields, there's an even bigger disparity. And same thing in US and obviously Japan. So you're getting a lot of valuation support from the fact that interest rates are so low. And that's fine provided they stay low. But as I mentioned, what happens if they do start to shoot up a little bit over the next few years? If they do shoot up over the next few years, then you need an environment of strong economic growth so that you've got strong earnings growth to offset that. And we're not quite in that environment just yet. Okay, so where do we think asset classes are headed? You know, this is just an interesting chart that is updated monthly by Citigroup and their global strategists. So it effectively takes all of the major markets, all of the different asset classes, includes commodities and all sorts of things, and has their return forecast going forward. I won't comment too much on the commodities, but if you look at Brent, they're expecting oil prices or crude oil prices to be 25% higher 12 months from now. Most of the equity markets, they've got, you know, sort of 0 to 10% return expectations across emerging market equities, global equities in general, developed market equities, S&P 500, European markets, but negative expectations from fixed interest markets. Which makes sense if you're in an environment where you're starting off with a security that's giving you a negative yield or a 0.5% interest rate. It doesn't take much of an interest rate, a positive interest rate move to see negative returns from that asset class. So even though valuations are relatively full, if you're trying to allocate money today and there's a big chunk of the market that you expect negative returns from, then you'll see money continue to flood to these asset classes, which will push valuations potentially, not just keep them at the upper end of the band, but push them a little bit higher. It is a risk, though, that you know, when interest rates push up, they will come back. This is another interesting chart, and it talks to the changes that we've made in portfolios just over the last month. So if you go back just to 30 June, these were the index forecasts or the market forecast from Citigroup going out to mid-17. So the S&P 500 was at 2099. They were expecting it to go to 2250 by mid-17. So they've got about a 7% expected return from the S&P 500 over 12 months. If we have a look at what happened in July, the S&P 500 put on 5%. So you've had almost a year's expected returns in a month from most of these asset classes. If we look at the S&P ASX 200, their fair value target for mid-2017 is 57.50. We're at 52.33 at 30 June, where almost 5,600 today. We put on 6% in a month. So in that environment where we're at the upper end of the band for most of these asset classes, and we've had such a violent move over the last month, to us, it warrants just building up a little bit of cash. Now, we don't expect an economic downturn. We don't expect markets to come off 20%. But if you're starting at a point where they're pretty fully valued with risks out there, then it makes sense to hold a little bit of cash. And I would expect that trading the volatility actively will add value or continue to add value over time. So we do claim to be genuinely contrarian when markets are really undervalued, provided we don't think there's a recession around the corner. We'll increase equity market exposure. When we've had these big runs and we're sort of scratching our head at valuations, then we will be fairly active and we will build up cash. Okay, so the key risks, I've spoken a bit about what's happened and how things are priced, but not necessarily about the risks out there and why we'd want a little bit of cash at the moment. Political shocks. So obviously we had Brexit, and we wrote a bit of commentary at the time. We built up a little bit of cash pre-Brexit. When the vote happened, markets fell fairly quickly into 30 June, and we do a little bit of buying over that period, and markets have since recovered. Our view was very much that if you did get a vote to leave the European Union, there would be initial market reaction, but it would wash through fairly quickly, because ultimately they still have to invoke Clause 50, which gives them 2 years before they physically leave the European Union. So there's 2 years for them to negotiate new trade agreements and work out what the new operating environment will be. So effectively, the day after the vote, the status quo remains, and it will remain for the next 6 or 12 months. So if there was a violent market reaction, then that was a short-term opportunity. Having said that, though, markets have not bounced back to where they were. They've moved to a significantly higher level. So now they're not discounting any risk at all. But we still are in an environment where there are issues around Brexit. So you've got, Netherlands, or people in the Netherlands and France that are very disgruntled with the EU. You've got other member nations that parts of their political structure are talking about exiting. So this will no doubt pop its head up again at some point over the next little while. The Italian bank environment. This is one that surprisingly hasn't gotten a lot of press, but the Italian banking system is really, really stressed at the moment. The expectation is, and we saw the European Central Bank do another stress test on the Italian banking system just the other day, and it was their estimate that there's about 360 billion euros of non-performing loans in the Italian banking system. So what that would mean is that the Italian banks would need to raise about 40 billion euros to fund the write-offs in that loan book. Now that's quite an issue. The European Central Bank will try to support the Italian banking system, and they're pumping money into the market, but they can't directly fund Italian banks unless creditors are bailed in first. So creditors or equity holders need to take a hit first before the European Central Bank is actually allowed to help. So that's a risk that is boiling, and I've got no doubt the European Central Bank will take action and they'll resolve the issue. But at the moment, markets aren't really discounting that as a particularly big risk. We've got the US election, obviously. So that's November 8. That could go either way. I mean, nobody was expecting the Brexit vote to happen, but it did. And the other one, which I know I harped on, but I really think it will be the key driver of financial markets over the next 12 to 18 months, is that quantitative tightening. Given what happened at the start of this year, and given the Brexit vote, nobody is pricing in any meaningful rate increases over the next little while. And we just think that's wrong, and that will change at some point in time. It may not be in 3 months or 6 months, but at some point it will change. And the other key issue that's out there is Chinese debt levels. And again, I've got slides on this if anyone wants to drill into the detail a bit more. But there is a lot of debt in the Chinese system. It's not like the GFC, it's not like the US or what we saw in Europe or even the Asian crisis in 1997, because China doesn't owe money to anybody else. There's a lot of debt within their corporate sector. There's a lot of debt within their local government sector. But at the federal level, at the national level, China is running huge current account surpluses and has massive foreign exchange reserves. So it is an issue that they should be able to resolve, but it's still one that's worth watching. And so finally, on that quantitative tightening point, we're genuinely of the view now that, more stimulus is not necessarily going to be good for the market, in that if Europe and Japan move further into negative territory, or they continue to print too much money and start down the path of even more unusual policy, we think that poses a bit of a longer-term risk, because ultimately more stimulus will have the impact of further devaluing currencies, which then has an inflationary impact down the track, which then leads to higher rates. And nobody's pricing in any movement in rates at the moment, but that's the end outcome of what they're trying to achieve. So I'll finish with this quote, which I really like, that we had in the February presentation, was that, the time to have turned negative on the ASX 200 was 5,900 in Feb last year, when everybody was panicking and everybody was negative equity markets in February this year and the market was below 5,000. That wasn't the time to be negative. That was the time to be bullish and constructive and increase exposure. Again, if we look at the environment after a 17% run in 3 months, where nobody is really talking about any risks out there and asset classes are fully priced, it's our view now is the time to be a little bit cautious. Okay, so I'll run through the portfolios in a little bit of detail now. So our large cap Australian share portfolio, we still have, as I mentioned in those charts earlier, the banking sector to us still looks reasonably priced and somewhat undervalued. So we still have a pretty good exposure to ANZ, Commonwealth Bank, Westpac and National Australia Bank, so all the majors. And we also have some funds management or wealth management financial services exposure via AMP and Henderson. And I'll touch on Henderson and CYB within our core share portfolio. I'll just bring up CYB. So CYB is Clydesdale Bank, which is the UK bank that was spun out of the National Australia Bank. So it was spun out of the NAB in Feb, early this year. And in March, April, all of the main brokers around the world picked up coverage of it as a separate entity. Now, the opportunity there is for Clydesdale Bank that now has autonomy and independent management that can actually run the business themselves, not run the business under the stewardship of NAB. Then there is a huge opportunity for them to run that more efficiently and to strip cost out. So their cost to income ratio is significantly higher than the rest of the banking sector in the UK. So you saw the stock run from $4 up to $5.60. Then we had the Brexit vote. All of a sudden, it fell nearly 40% overnight. So that was the sort of reaction that we were talking about. If there is a real negative financial impact on the back of a Brexit vote, it'll throw up opportunities, but there are opportunities to buy. So we put in, just at this point here, we put in CYB at a 1% weight. It's not a big position, but just a 1% weight. It got crunched for the next few days, but over the next month or two, people realised that, hey, the UK is muddling along and, it's not the end of the world for a UK bank. We did a similar thing with Henderson, where we increased exposure. So it was a stock that we held. We sold a little bit of it heading into Brexit. Not that we thought Brexit would happen, but it was just a hedge in case. It did happen and the stock was hammered. So we increased exposure here and it's starting to recover a little bit. The other stock that we bought, and I'll talk about that now in the portfolio, this is, just move back to the 12-month chart, is Boral. So Boral's a stock that we quite liked, struggled on valuation grounds. After the Brexit vote, it was sold down nearly 15%. Which gave us an opportunity to buy that. Now at $7, it's actually pretty fully priced, so we're debating whether to sell that position or not. But the Brexit Brexit sell-off did create some opportunities, and we do try to be opportunistic when we can and take advantage of that market volatility. So we've got an overweight exposure to the banks and fund managers. We've also, as I mentioned, recently put in Borrell, and we increased exposure to Lend Lease. Now, those guys are very leveraged to the expected infrastructure boom that will hopefully commence next year and be in full swing in 2018. So again, in a lot of the work that we do, we're trying to have a look at where we are in the economic cycle, not just of the overall market and the overall economic cycle, but where each of these sector cycles are. So if you look at Borrell, the US housing market is continuing to recover, and they've got a US building materials business. You've got the Australian business that has kind of muddled along but picked up a bit in the last 12 or 18 months with lower rates and reasonable non-mining infrastructure investment. But you've got almost every state and the federal government has announced huge infrastructure projects that will start in 2017 and 2018. Borrell has almost exclusively East Coast exposure. It's not exposed to the West and to the mining sector. Now, if those projects do commence, there's literally not enough capacity to produce the concrete required for those projects. Borrell has an export business, and about 2 months ago, we saw for the first time an actual increase in the concrete price. So they're actually now able to push prices up, and they're positioned for that boom. So yeah, interesting stock. Lend Lease, almost exactly the same thematic. We still like the healthcare sector. That has been our biggest overweight exposure for the last few years. So we've got Ramsay in there, Sonic Healthcare, and CSL. They constitute around 12% of the portfolio. So big overweight exposure there and comfortable. We did take a little bit off the table just recently, so we just trimmed them a little bit because they're all expensive. But longer term, with an ageing, wealthy population and a health insurance system that really funds their growth, we love the longer term thematic. The other thematics in there are overseas earners. So we've been looking for companies that are earning in US dollars and have overseas businesses, particularly because the US growth rate is actually stronger than ours at the moment, but also because if you have US dollar earnings and the Aussie dollar depreciates, then they're worth more as you repatriate that. So Amcor, for example, has only a small proportion of Australian earnings, and the healthcare stocks fall into that realm as well as some things like Seek. The other one opportunistically that went in fairly recently was Tats. I'll pull that up as well. So the Tats is a really great defensive business. They lost the high federal court case a few months ago, where effectively when they lost some of their licenses going back a long time ago, they sued the federal government. They won compensation of $400 million. The state government fought that, took it to the High Court, and they lost. So effectively, the loss of the court case cost them $400 million, and we saw a really sharp share price reaction on the back of that, as you'd expect it. But fundamentally, that doesn't change the nature of the assets of the business or the operating earnings of the business going forward. So that was an opportunity for us to put that in. So comfortable with how the portfolio is constructed, but as I mentioned, we've now moved to 20% cash, and we think that the reporting period that commences next week will hopefully throw up some ideas to deploy that cash. Or if we see any of those market risk events start to capture headlines and see a bit of a downturn, then we've got some firepower to buy the market. What we haven't done well, so I've talked about the current structure and what we've done well there. What we haven't done well over the last 12 months is we haven't had exposure to those listed property trusts and those infrastructure and utility stocks, because we view them as being extremely expensive. And it's a bit like that bond fund manager that's bought bond yields at negative rates. They've gone from expensive to extremely expensive in our view. So again, we're concerned about that sector and we're happy not to have any exposure there. The income portfolio, I'll flick through this fairly quickly. Now again, in a low interest rate environment, what we like, or the way that we think you can get sensible, real income returns without taking too much risk, is from the listed debt, listed corporate debt and hybrid sector. So all our income portfolio constitutes about 14 listed hybrid and debt securities at the moment. The current running yield on the portfolio is around about 6%. So it's a sector that was really mispriced 3 or 4 months ago and is starting to perform pretty well. So if we're sitting here in Australia with government bond yields at sort of 1.8%, a cash rate at 1.75%, the best sort of deposit rates you can get around 3%. Getting 6% from listed corporate debt looks pretty attractive to us. And we're not taking a lot of credit risk here. If you look at the names, they're most of our major banks, AMP, ANZ, Bendigo, CBA. So they're all companies that we're comfortable don't pose any credit risk. I've been jabbering on for a little while, but I'll just talk briefly about the hybrid sector because it did underperform in 2015 and it started to perform strongly again in 2016. And what we saw was the margin or the trading margin of the securities, so what they pay over the cash rate, blew out over the last 12 months, which was an unusual development given that interest rates were being pushed down globally. So if we look at the major bank hybrids here, ANZ, NAB, Westpac and CBA, they were paying around about 3.5% over the 90-day bill rate as an interest margin or as an interest payment that you would get. That blew out to over 5% going into early this year and about March this year. So some of these securities you were getting sort of 7 and 8% yields. Since then they've come back into a little bit over 4%. Now our view is that they can probably push back to about 3.5%. So if you're starting with a 6% income rate and that trading margin pushes from sort of 4.5 back to sort of 3.5, you'd expect those securities to push up by 2 or 3% as well. So in a really difficult low rate environment, that's actually a sector that we think stands out and represents some fairly good risk adjusted returns. I got Ben to duck in briefly. This is our emerging leaders portfolio. I don't go through all of the stocks there, but these are the companies that we hold or that we like that are outside the top 100. So they're from ASX 101 to sort of 300, and there's a few that are outside the 300. The key point that I'll highlight there has been how difficult it's been not having a big exposure to the resource sector. We don't hold any resources in the core share portfolio and we're pretty comfortable with that outlook. That was a great call in 2015. It hurt in the first part of 2016, but we're very comfortable that you don't want to chase that sector. In the small space, so the small industrials, in the first part of this year have only put on sort of 2.5%, but small resources have put on almost 70%. But that's after 3 years of being absolutely decimated. So again, we don't want to chase that sector, and I can let Ben's the portfolio manager for the emerging leaders portfolio who can talk through any of that in more detail if you like.
I'd like to invest in that retrospectively. Look, we've got to be pretty prudent about the way we invest in that sort of space. We've only had 2 investments over the last probably 6 months, whilst as Adrian alluded to, the sector really has skewed the performance of the space, and we've always had pretty outstanding performance in the SMA. And so it was only in January of this year that we were kind of pushing sort of 30% outperformance on the small ordinaries, and that's contracted back into 10%, but we're still comfortable with the way we play it. I mean, it hasn't just been the resources, obviously, as a byproduct. You've had some of the mining services businesses that have been decimated also bounced dramatically. And as you saw in that chart, you've had 73.6% outperformance on what constitutes about 18% of an index. It means that you have to make up in something that's done 2.4%, around 19%, which is difficult, which we haven't been able to do. So I suppose our outperformance has come back in a little, but look, on the 6th of August this year, we reached our 3-year mark on the SMA, and the SMA will be around 20% every year since inception, compared to the small ordinaries, which will be around 10% or a little bit under. So we're really comfortable that sort of that performance. We think it's will be nice in and around the best in the market. And as Adrian alluded to earlier, I think the key takeout that I was trying to put, convey to investors is that the predominant amount of the stocks that we look at are the 100 to 300. So there's all sorts of mandates for emerging or smaller companies. Ours is pretty conservative. Our mandate in terms of the filtering process for stocks is very conservative. So we are really skewed to that 100 to 300 area of the market. We I think you can safely say that the risk is lessened. So even if, as I said earlier, carjacking, that I'd like to go back retrospectively and invest in some of the recovering mine services stocks by sheer derivation, they probably weren't, with the quality filters that we extrapolate over the stocks we invest in, they wouldn't have been fit to go ahead with anyway. So I'm not sure if anyone's got any sector-specific questions for me. It's really difficult, I think, to talk about that space at the moment because Adrian and I have spoken about it probably every morning for weeks now, and it fluctuates violently. The one that I think has attracted the most press has been lithium. And everyone's trying to work out a way now how you play renewable batteries or lithium batteries that are going to power electronic vehicles and the like. So you've seen something of an Cobra and a Galaxy Minerals and another one I can't remember, do quite well. It was interesting, we went to Adrian and I attended the Citigroup, which is their head resources analyst based in Asia. And he said it was interesting, he went to a resources conference based in Nevada. And so the reason he'd be really scared to play with junior lithium players is because if you talk to the majors who are already getting a lot of that out of the ground, they're saying it'll do okay, it'll do well from a supply demand for me. Lithium's not going to the roof, but all the junior miners are like, this is the next big thing. Just got to start taking this out of the ground, blah, 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 blah. So we're pretty comfortable not trying to sort of chase what I think is a really high risk exposure. And look, at the end of the day, they've done particularly well, but I wouldn't be surprised equally if you saw a comeback quite dramatically. And really, if you look at the small resources space, particularly if you look at some of the gold producers, they're now 7.5% of the index. And they have put on around, I think as that 7.5% put on 80%. There's only really 2 or 3 that you would consider high quality out of the 9. And there's 3 or 4 of them that are losing money. And I still a little sceptical about their ability to raise capital or equity in this sort of market. So
at the end of the day, if you don't have to chase risk to get a 20% return, why would you? If you get 20% per annum on stuff that's not going to go belly up, not going to disappear on you, why would you chase small resources?
Yeah, to be candid, Steve, we've always been pretty, when we've spoken to presenters, I mean, we try to stick more around anything which we think is much more sort of fundamental bottom-up analysis of businesses and stocks. And I think it's a lot easier to do that in your industrials as opposed to your resources sort of players. Particularly in this space, as I said, when you've got stocks that aren't making money, and you're talking about sort of prospecting. I know in 20 years of advising clients, there's nothing worse than if you get something badly wrong, and I've certainly done that in the past, and then sit down with the investor and explain the rationale behind it. So the older I've got, I want them to be absolutely ironclad in terms of the rationale behind why you want your investment, whereas you can still find yourself going to some presentations with regards to particularly small resources, and I still don't understand it. About the grade of what's being dug out is essentially it's almost like a test tube that goes into the ground, and then they try and extrapolate that over kilometres. So like, it's almost fast because you walk over there and speak to other sort of fund managers, and so I'll show you, a map of the area, and the middle bit will be this glowing purple. And I'm not joking, I've walked there a couple of times around the fund managers, and I know, did you see how white that purple is? I mean, it's sort of really,
unless you're a geologist, it's not our area of expertise.
Really. So we prefer to wait till those sort of businesses are cash flow positive and the mines have been developing as opposed to 2 years out, because anything can sort of happen. With regards to some of the other players in the portfolio, if you were to look at it in isolation, I think that some things get qualified as retail are a little bit probably more circumspect in terms of that, particularly something like an automotive holdings group, which is basically car franchises. Gap or Lifestyle Group is certainly not retail. That's more play on residential development in the aged care space. And Burson Group, for me, is really almost like a consumer staple that services your cars and the like. We're really happy with the mix we've got. As Adrian said with regards to the call, we've got a 17.66% cash exposure, which we think is sort of prudent going into the reporting season.
Yeah, and just to recap, and it's very similar to the core share, and I'll touch on the international as well. You know, almost all of those businesses, there's one or two that aren't, but they're all profitable businesses, generating positive cash flow and paying dividends. As Ben mentioned, we've actively managed that cash weight. Being an emerging markets portfolio, these stocks can bounce around a lot more, so you generally want to hold a bit of cash for opportunities. But if you go back to Feb and March, we only had 2% cash. That was the most full the portfolio had ever been invested in the 3 years, just because of where we were. And now a few months later, it's back to almost 20% cash. So we do actively manage that. That's 3-year performance next month, and it's done 20% per annum for 3 years. So has done really well, despite not holding resources over the last 6 months. The international portfolio, the OneView platform has recently launched their direct international equity service. We've run this portfolio on another platform for sort of 5 years, but it's the same philosophy. It's exciting in that a lot of clients now can get access to direct international equities where they couldn't before, but you're getting access to really high quality global companies, and we take the same approach where it's a fundamental approach, and these are all businesses that will get through any economic cycle. So, you've got the Cokes and Procter & Gamble's, Colgate's, Costco, Amazon, Home Depot. They're all businesses, big global brands, or most of them are big global brands that you would know and understand. A few of the banks, Wells Fargo, US Bank Corp, but Berkshire Hathaway and American Express, General Electric, 3M, and obviously the tech stocks that you don't. There are tech stocks here, and there are quite a few of them in the emerging leaders portfolio, but they're not the likes of Microsoft, Intel, IBM, or Google. So exposure there, and I'll flick through this very quickly because of time. And what we do is we pair the direct US international share portfolio with an ETF portfolio to get exposure to other markets. So to get some exposure to Europe, to Japan, but we've actually just put in a slight short position there in the US market. So as I mentioned the other day, earlier today, if we look at the S&P 500, the US economic outlook is okay. The US market's just gone from post-Brexit to where we are today. It's put on sort of 6-7% in a few weeks, and it's trading well above the recent range, and we can pull that back to sort of 2 years. So we've very actively traded in that ETF portfolio and delivered some pretty good outperformance. We've traded that volatility. So we put in a geared US exposure here, we sold it here, and now we've put in a small short position there. So we really are trying to be active in what is a volatile market, but basing our investment decisions on what the underlying economic reality is. So that's us. So in summary, we're more neutral equities at the moment given valuation, but we still very much think it's a buy the dips market. Bonds and bond-sensitive sectors are extremely expensive, and we've got a short-term high cash weight position for all of those reasons mentioned.